In the last 52 years, silver has only done this 2 times. We are now living through the third. What I am about to show you, this has only happened twice in modern financial history. And understanding what happened after those 2 times could be the difference between life-changing profits and devastating losses. We are witnessing a price surge that is taking silver into uncharted territory, screaming past $100 an ounce. This isn't just another market rally. This is what we call a parabolic move. It's a rare, almost mythical event, and both times it happened before, silver did something dramatic. One time it created generational wealth. The other time it trapped investors for years. In this video, we're going to break down exactly what happened in the past during those first 2 historic waves. We will dissect the stories. Then, we will turn to today, to right now, and analyze the powerful forces driving this third, unprecedented surge. The critical question we all need to be asking is this time different? By the end of this deep dive, you will understand the pattern, the players, and what could come next. So pay attention. This might be the most important silver analysis you watch this year. What we're seeing right now in the silver market is a convergence of factors so powerful, it's being called a perfect storm. The price has exploded, posting a spectacular gain of nearly 150% in 2025 alone, and continuing its parabolic rise into early 2026. This has pushed the price to levels never before seen, hitting as high as $120 per ounce. This is only the 3rd time silver has reached these kinds of extreme price levels relative to its historical performance. The last 2 times this happened, it created fortunes for a select few and ended in absolute catastrophe for everyone else. History rarely repeats itself exactly, but it often rhymes. And right now, the rhyme is deafening. Section 1. The first wave. The Hunt Brothers' billion-dollar gamble. To understand the magnitude of what's happening today, we have to travel back to the late 1970s. This was an era of crippling double-digit inflation. People were watching their purchasing power evaporate. The dollar was under siege, and faith in the financial system was collapsing. Amid this turmoil, 2 Texas oil heirs, Nelson Bunker Hunt and William Herbert Hunt, embarked on one of the most audacious financial plays in history. They believed silver was dramatically undervalued and that paper money would soon be worthless. So they started buying. They weren't just buying a few coins. They were buying everything they could get their hands on. Physical bullion by the ton, even chartering Boeing 707s to fly their silver to secure vaults in Switzerland. And they amplified their buying power using the futures market. By the beginning of 1979, the price of silver had already risen to around $6 per ounce. But as the Hunt's buying intensified, the market went into a frenzy. It's estimated they controlled over 100 million ounces, roughly 1/3 of the entire global supply of privately owned silver. They had effectively cornered the market. The consequences were immediate and dramatic. The price of silver went vertical. From $6 in early 1979, it peaked at a breathtaking price of around $49.45 per ounce on January 18, 1980. That's an increase of over 700% in just over a year. The real-world impacts were chaotic. Industry struggled. Families began melting down heirloom silverware to cash in. Tiffany & Company took out a full-page ad in the New York Times to condemn the Hunts, writing, "We think it is unconscionable for anyone to hoard several billion dollars worth of silver." But here's what you need to understand about parabolic moves. They are exciting. They create massive wealth. But they are also dangerous. This bubble, built on pure leverage speculation, was destined to burst. Regulators had to act. On January 7, 1980, the COMEX Exchange introduced a new rule that would go down in history: Silver Rule 7. This rule suddenly restricted the use of borrowed money margin to buy silver futures. It was a death blow to the Hunt's strategy. The end came swiftly and brutally. The day the market truly imploded is known as Silver Thursday, March 27, 1980. On that single day, the price of silver collapsed by nearly 50%, falling from over $21 an ounce down to $10.80 in a matter of hours. The Hunts received a margin call for $100 million that they could not meet. Their paper profit of billions evaporated almost instantly. The collapse was so severe it threatened to bring down the entire financial system, forcing a $1.1 billion bailout loan to stabilize the markets. The first great silver wave was over. It was a textbook speculative bubble, a cautionary tale written in the language of greed and fear. Section 2. The Second Wave, a Crisis of Confidence. 31 years later, silver would peak again, reaching a high of nearly $48 an ounce in April 2011, almost perfectly matching the nominal high of the Hunt Brothers bubble. But the story behind this second wave was fundamentally different. This was not the work of a few powerful speculators. This was a global phenomenon, born from the ashes of the 2008 financial crisis. The catalyst this time was a profound loss of faith in the entire financial system. The collapse of Lehman Brothers, the housing crash, and the massive government bailouts had shaken the world. Investors, from large institutions to everyday people, were terrified of currency devaluation and were desperately searching for a safe haven, a real asset that couldn't be printed into oblivion. They found it in precious metals. Gold began to climb, but silver, being a much smaller and more volatile market, began to move with explosive force. The narrative driving the 2011 rally was powerful. First, there was the monetary fear. Investors piled into silver, seeing it as poor man's gold. This wasn't a leverage play by a few billionaires. This was a grassroots movement. Dealers of physical bullion were overwhelmed. There were widespread shortages of investment coins, not because there wasn't enough silver, but because production couldn't keep up with the frantic demand. Second, there was a compelling industrial demand story. The green technology revolution was starting to surge. The solar panel industry was growing at an incredible rate, and silver is a critical component. Between 2008 and 2011, silver demand from just the solar industry grew by over 300%. This added a powerful fundamental argument to the speculative fire. The price action reflected this perfect storm. Silver climbed from under $20 in mid-2010 to nearly $50 by the end of April 2011. The market was electric with FOMO, the fear of missing out. But just like in 1980, the peak was sharp and the fall was vicious. The end of this rally was also triggered by changes in margin requirements. As the price went parabolic, exchanges moved to increase the amount of money traders had to put down to hold silver futures. In the span of just a few days, the price of silver plummeted by more than 30%. The second wave had crashed. The pattern was strikingly similar. A rapid, parabolic price rise driven by a powerful narrative, followed by a sudden and painful collapse. The lesson was reinforced. Silver's volatility could be devastating. We've just walked through the two most dramatic boom and bust cycles in silver's history. These patterns are critical to understanding what is happening right now. If you're finding this historical analysis valuable, and you want to stay ahead of the curve, take a moment to subscribe to the channel and hit that notification bell. We go deep on these topics every week to give you the context you need. Section 3. The Third Wave, a Structural Revolution. And that brings us to today, January 2026. Silver has not just revisited its old highs, it has smashed through them, trading at levels above $117 an ounce. This is the third great wave. But as we look closer, we see that the very foundation of this rally is profoundly different. This isn't just about speculation or monetary fear anymore. This is about a deep, structural imbalance between supply and demand. What's really driving this surge? It's a combination of factors creating that perfect storm. The most important factor, the one that truly separates this rally from all others, is a persistent and growing structural supply deficit. For 5 consecutive years, the world has been consuming more silver than it has been producing. The market deficit for 2025 alone was estimated to be around 118 million ounces, and 2026 is expected to be the 6th straight year. This is not a temporary bottleneck. This is a chronic shortfall. Layered on top of this supply crisis is an explosion in industrial demand, driven by the biggest technological shifts of our time. The green energy revolution is happening now, and it is incredibly silver-intensive. Solar panel manufacturing is a voracious consumer. The electrification of transport is another. Electric vehicles use significantly more silver than traditional cars. As EV production ramps up to millions of units, this creates another massive source of demand. But it doesn't stop there. The AI revolution, data centers, the rollout of 5G networks, all of these rely on silver for its unmatched conductivity. In late 2025, the U.S. government officially added silver to its list of critical minerals, a formal recognition of its indispensable role. This isn't speculative demand that can vanish overnight. This is structural, baked-in demand from the foundational industries of the 21st century economy. At the same time, the monetary case for silver is as strong as it has ever been, with falling real interest rates and deep concerns over staggering levels of public debt. And finally, the gold-to-silver ratio, which blew out to over 100-to-1 in 2025, was a coiled spring. When sentiment shifted, silver didn't just catch up to gold, it dramatically outperformed it. So the third wave is not just a repeat of the past. The 1980 peak was an artificial bubble. The 2011 peak was a panic-driven rally. The 2026 surge is built on something far more tangible, a verifiable supply deficit clashing with an unprecedented wave of essential industrial demand. Section 4. The Two Paths. Fortune or Collapse Revisited. This brings us to the most important question of all. Where do we go from here? Are we on the path to a new, higher plateau for silver? Or are we setting the stage for the most spectacular collapse of all? Let's analyze the two paths forward. First, the bull case, the path to fortune. Proponents argue that the structural deficit is the game changer. The high prices we're seeing are a necessary signal to the market. For supply to increase, the price needs to be high enough to justify the massive investment required to open new mines, which can take 7 to 10 years. In this scenario, the price isn't in a bubble. It's discovering a new, fundamentally justified level. Industrial demand is largely inelastic. Tech giants will still have to buy it. Some analysts have even forecast a potential surge to $150 per ounce. This path suggests we are in the early stages of a long-term repricing of a critical commodity. Now let's look at the other side, the bear case, the path to collapse. The first warning sign is the sheer velocity of the price move. A 150% gain in 1 year is not normal. It's a classic symptom of market euphoria. No asset goes up in a straight line forever. The market is extremely volatile, and profit-taking is inevitable. While the industrial demand story is strong, a global recession could still put a dent in it, and high prices create an incentive for thrifting, where manufacturers invest to reduce the amount of silver needed in their products. The investment demand, which poured fuel on the fire, is notoriously fickle. If central banks pivot to a more hawkish stance, the safe haven bid for silver could evaporate as quickly as it appeared. In this scenario, while the structural deficit provides a higher floor for prices than in the past, the speculative froth on top could be blown away in a violent correction. A collapse might not mean a return to $10, but a rapid 30 to 50% pullback is well within the realm of historical possibility. We stand at a remarkable moment. We have seen the blueprint for these events play out twice before. First, with the Hunt Brothers speculative mania in 1980. Second, with the 2011 crisis rally. Now we are in the third wave, a wave defined by a price that has soared past $100 an ounce. But this time the story has a crucial twist. A multi-year structural supply deficit is colliding with an explosion of non-negotiable industrial demand. This does not make silver immune to a collapse. The recent volatility is a stark reminder of that. A sharp, painful correction remains a very real possibility. However, the underlying fundamental support for silver is stronger today than at any other point in modern history. The path forward will be a battle between the undeniable reality of the supply-demand imbalance versus the historical tendency of speculative manias to end in tears. History rarely repeats itself exactly, but it often rhymes. Whether this current rhyme leads to a new era of sustained high prices or another spectacular collapse will depend on the very key factors we've broken down today. Understanding this pattern is the first step to navigating the opportunity and the risk that lies ahead. The relationship between gold and silver is one of the most critical drivers of this entire story. To see my detailed analysis of where gold is headed next in this environment and how that could impact the price of silver, click and watch this video right here.